Did you know the biggest mistake most people make when using exchange-traded funds is in purchasing a single broad market index? Exchange-traded funds are diverse, flexible, and cost-effective. However, if you want to know the most effective way to use these ETFs, then be sure to stay tuned until the end when I reveal the technique that all institutional portfolio managers are using to maximize the use of ETFs in their billion-dollar portfolios. The COVID-19 pandemic prompted many investors to look more closely at their investments and made it clearer than ever why it's important to know what you own and understand how it works. Many portfolios include exchange-traded funds. In fact, as of July 31st, 2020, Canadian ETFs had attracted a total of $230 billion in assets spread across 811 funds from 36 different firms. One of the reasons exchange-traded funds are popular amongst investors and their advisors is that as the sector has grown, so has its diversity. That means ETFs can be put to work to achieve a range of objectives within an investor's portfolio. An ETF trades on an exchange, just like an individual stock. That makes ETFs very easy to buy and sell, and it also means they are priced throughout the trading day, unlike mutual funds, which are priced at the end of each trading day. ETFs generally offer low fees because they have lower operating costs, transparency with holdings reported every single day, and potential tax efficiency when portfolio turnover is low. Keep in mind that the savings associated with low fees and tax efficiencies are magnified over time, so investors benefit the most from these features when they hold ETFs for the long term. The three top ETF providers in Canada are BMO Asset Management, BlackRock, and Horizons ETF. Over the past 3 months, $3.6 trillion has gone into ETFs amongst these three companies worldwide. That's equal to the total GDP of Australia, South Korea, and the Netherlands combined. With so much money going into these assets, I want to make sure that you know how to differentiate between the different kinds of ETFs. First, we have passively managed ETFs. The first ETFs introduced in Canada over 30 years ago were structured to replicate the returns of a specific index. Instead of actively choosing investments, the managers of these early ETFs set them up to match the holdings of the indices that they were tracking. They were passively managed, simply matching the index without really trying to outperform them at all. Today, passively managed ETFs continue to deliver low-cost exposure to specific areas of the market. Depending on the index tracked, these ETFs may hold stocks, bonds, commodities, currencies, options, or a blend of alternative assets. Actively managed ETFs. 20% of Canadian ETFs are actively managed. Essentially, they're just mutual funds with little to no management fees. With an actively managed ETF, a portfolio manager carefully selects individual stocks, bonds, or other assets, just as he or she would do for an actively managed mutual fund. The difference is that the portfolio is structured as an ETF with all the ETF's benefits, including low fees and potential tax efficiency. As with any actively managed investment, the goal is generally to beat a benchmark index, which is something a passively managed investment by definition cannot aim to do. Strategic Beta. As of November 2nd, 2020, the Strategic Beta ETF, FNGU, has earned a whopping 267% return for the year. Strategic Beta ETFs, also known as factor-based ETFs, mix elements of passive and active management. They're passively managed in the sense that they apply specific rules to determine what holdings to include in the portfolio. However, the rules themselves favor certain types of securities or holdings so that, as with an actively managed ETF, Strategic Beta ETFs have the potential to outperform their benchmark index. A strategic beta ETF may give preference to things like value stocks, growth stocks, low volatility stocks, or any other group of assets that can be clearly defined. With a rules-based approach, Performance does not necessarily depend on the manager's day-to-day decisions, but rather on the disciplined adherence to the factor model, which offers two advantages. One is that even professional money managers can be subject to behavioral biases that affect all investors, and that may diminish returns. Second, less hands-on involvement generally means lower fees. So how do you incorporate ETFs into your portfolio? In 2018, 72% of the overall ETF market was held by Canadian investors. Let's talk about how you should be incorporating these funds into your portfolio to increase returns and reduce your risk. Different types of ETFs can be combined in many ways to achieve specific goals. For example, passively managed ETFs can provide broad market exposure or target a narrow part of the market an investor wants to emphasize, such as dividend-paying stocks or short-term bonds. Actively managed ETFs can enhance a portfolio by adding a skilled manager's expertise and the potential for index outperformance. An active oversight on your portfolio may be especially important when markets are extra volatile. Meanwhile, strategic beta ETFs are a solution that an investor may use anywhere in a portfolio in an attempt to increase returns and/or decrease risk by emphasizing characteristics linked to long-term outperformance, such as company size, relative price, or profitability. You need to decide whether ETFs can contribute to achieving your goals and which types will best meet your needs based on your life stage, investment time horizon, and tolerance for risk. Creating a portfolio of ETFs with a mixture of passive, active, and strategic beta strategies could allow you to enhance your portfolio's return while also managing your risks. The secret sauce. So I promised to tell you my secret, so here it is. In my 7 years of managing millions of dollars investments for my clients, I've had the opportunity to speak with many institutional portfolio managers, and they've all told me the same thing with regards to ETFs. Using ETFs as a way to invest in the broader market index is an absolutely wasted opportunity. Despite this being a good strategy for beginners, these same billion-dollar managers have told me this instead. Exchange-traded funds should be used like a scalpel during a surgery, to carve out and invest in very specific industries and sectors to generate returns that would have otherwise been tossed into the overall average performance of the broader market index. With the instability in the current marketplace, here are some exchange-traded funds to invest in to carve out some extra returns for you. Number 1, Q-tips. This is the inflation-linked U.S. Treasury fund. If you have high-interest savings, use this as an alternative. For example, if inflation is at 2% and your personal high-interest savings account is at 0.5%, an inflation-linked Treasury holding will give you a 2.5% return. This is as close as you can get to an inflation-linked asset without exposing yourself to the volatility related to gold prices. Number 2, U.S. healthcare. ZUH. U.S. healthcare is always a good idea. As more research comes out reporting on the rising obesity rates due to increasing sedentary lifestyles, U.S. healthcare is going to provide good long-term value to your portfolio. COVID-19 has accelerated the home office life. Before the pandemic, we would usually get up and travel to work and maybe average 2,500 steps in a day. Now, we just get up, sit in bed, and attend a Zoom meeting. We've eliminated the need to travel and enabled the lazy to become lazier. There is also an opportunity here that will allow you to participate in the COVID vaccine sales once it has been commercialized and approved in the US. Number 3, utilities. ZUT. Utilities like electricity, gas, dams, and power generators will continue to generate income regardless of the pandemic, recession, or inflation. Regardless of if there is a pandemic, chances are you are still going to turn on the lights at home and start the stove to cook. Number 4, global infrastructure, ZGI. Global infrastructure allows you to invest in projects like roads, highways, bridges, and land developments. These are ideal projects that governments love throwing money at in order to help stimulate the economy. For example, countries like China are planning to spend $7.15 trillion USD on infrastructure over the next 4 years to stimulate their economy. It's as the saying goes, during the gold rush, it's not the gold miners who made the money, but the ones who sold the shovels and picks. Number 5. Global Consumer Staples. STPL. If you saw the toilet paper shortage at the beginning of the pandemic, then you know this investment is the truth. Consumer staples are companies that provide essential consumer products like groceries, toilet paper, baby diapers, and the lot. During a pandemic environment, as well as in recessionary marketplaces, this ETF would provide you with access to companies who will still profit during tough times. As you continue on your journey to investing, be sure to take an active approach in the management of your portfolio. ETFs are diverse, flexible, and cost-effective. Taking a passive approach will let you achieve the minimum market return, but by treating your ETF portfolio as a handful of scalpels, using them to carve out specific industries that will succeed in each market cycle, you will be able to maximize your portfolio returns while still maintaining a diversified, risk-managed plan. Thanks for tuning in. Don't forget to like and subscribe for more educational tips and videos like this.